Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Tech tariff warning. President Trump pledges that he will still apply tariffs to certain electronics, downplaying a weekend exemption. The dollar declined. The greenback drops to a 6-month low on concern that tariff policy will drive traders away from U.S. assets. And we discuss the looming global trade war and market turmoil with Mathias Döpfner, Axel Springer, CEO. I think a lot of people are going to be looking forward to the fact that this is a holiday-shortened week. After the best week for stocks since November 2023, we add some more weight to that rally. Tech outperforming, NASDAQ 100 futures up 1.7%, with tech getting a different band for tariffs. We have still yet to figure out what exactly that will be. I should say the downward sentiment's still out there. Citi downgrading U.S. stocks this week. Speaking of cracks in American exceptionalism, your bond market getting a slight bid. That's off the back of the biggest 30-year increase since 1987. We're lower by 3 and 2.5 basis points for your 2 and 10-year yield. Dollar is at new lows for the year. You can see the euro there stronger by 1/3%. We're going to get some more data this week. March retail sales, industrial production on Wednesday, and then we will hear from Fed Chair Powell on Wednesday. So those are your overall markets. Let's look at some stocks that we're keeping our eye on as it's 5 a.m. here in New York. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So we are seeing broad-based gains across the tech space in the pre-market trading today. Take a look at Apple. We're up around 5.5% for this stock at the moment. Trump, of course, announcing some exemptions on the tech sector at the weekend, though that has been slightly watered down, as you mentioned there, Danny. Another one moving higher is Dell Technologies. A similar thing. It's those exemptions feeding through into the hardware space as well. And then just on the chips, bear in mind, we did see a big drop in this space on Friday, but some of them coming back up this morning, including Texas Instruments. A good note out from Evercore analysts say they would buy on any weakness linked to Chinese tariffs on semiconductors. And then finally, Goldman Sachs, those equity traders there have been a busy bunch over the past quarter, and we're expecting to see that in the bank's quarterly report when it comes out later today, something we saw from JPMorgan on Friday. And, of course, all of these moves and more available on the Before the Bell opening wrap, which is available on the terminal now.
Yeah, we should get those Goldman earnings in about 2.5 hours. Joe, excellent work as always. Bloomberg's Joe Easton will catch up with you later in the hour. Coming up on the show, conversations you do not want to miss. We'll be speaking with Kelsey Berro of JPMorgan and Blackrock Global Chief Investment Strategist Wei Li. Now, Wei writes this: the pause, of course, that's the tariff pause and reciprocal tariffs of 90 days, suggests that the U.S. administration is taking some account of financial risks and costs, as well as the country's willingness to engage, putting a check on a maximal stance during the negotiations. As a result, we extend our tactical horizon back to 6 months to 12 months from 3 months to dial up risk. I'm pleased to say that Wei joins us now. Wei, I mean, what a past 2 weeks it's been. It's felt like a decade. But this comes off the back of just last Monday. You had turned more bearish on stocks, downgrading them to neutral. Why the change this time around?
Hi there. Good morning, Danny. Thanks for having me. So the big picture that we have always said is that in the near term, because of policy uncertainty, assets could come under pressure. But over the longer term, fundamentals should prevail, and that should allow us to be more positive on risk. So that big picture has not changed through the course of the last 2 weeks or so. But immediately after Liberation Day, the significant amount of policy uncertainty and also our sense that it wasn't looking as though any of the checks were having an effect or binding policy for the administration. That made us feel that we really couldn't see very much further ahead, which is why we shortened the tactical horizon immediately after the Liberation Day from 6 to 12-month horizon to 3 months, because that's how much further we felt that we could see ahead. But as we did that, we also said we didn't know how long or how short that period would be. And then came last week the pause, the walk back, and lots of kind of back and forth, even as that news was breaking. But the big picture here is that the piece that we didn't feel that we had assurance for 1 week ago, i.e. some of the checks and countervailing forces were binding, we were able to get assurance last week that they were indeed binding, be it Treasury bond yields, be it pushback from allies in the business community. But whatever it is, there were binding forces, and that was important for us to have confidence that there is a landing zone over the slightly longer term. And when we said that we didn't know how long or how short it would be, it turned out to be quite short. And then we then felt comfortable to stretch the tactical horizon from 3 months to 6 to 12 months, which is the horizon over which we were a bit more positive because of the still okay fundamentals. I know some of the sentiment indicators were falling quite quickly, but hard data are still holding up. So it very much depends on how long this period of uncertainty lasts.
I was going to say, Wei, because at what point do the headline changes themselves make it too volatile to be overweight on risk assets? You've had two U-turns, let's call them, recently, the 90-day reprieve for reciprocal tariffs on tech. But even with tech, we get itself of Trump putting on Truth Social over the weekend saying that no one is exempt, that tariffs are still going to be coming for tech. They are just coming later down the road. Does that type of volatility in itself pose a risk to equity markets, even if there does seem to be some sort of check now?
I will make the broad observation when you say risk assets, there is equity, there is credit. But I think right now government bonds are also part of that. If you look at the significant rate repricing that we have seen in the last week and longer in the face of inflationary fear and also term premium going higher because of fiscal concern. So in this environment, when nothing is really risk-free or safe, it's from a whole portfolio perspective, we just gotta kind of think about how we construct a portfolio that can navigate this level of volatility and uncertainty. And I would also say, when we say U.S. equities, we're resuming our overweight over the 6 to 12-month horizon, I would observe actually at times of tariff uncertainty, international markets were not immune. In terms of the correction, peak to trough drawdown after liberation, Japanese equities, European equities, they came under just as much pressure as U.S. equities. The amplification effect of tariffs on a global basis means that there is no country that is really shielded. So we really have to think about it from a kind of a whole portfolio construction perspective. And against that backdrop, I would note that gold has been a better diversifier than treasuries, long duration treasuries in this environment of inflationary pressure still, and also high debt. The last thing I would say is that in terms of the read across from tariffs to growth, we have the uncertainty effect. The longer it lasts, the more kind of it puts capex and big spending decisions on hold, that feeds through to growth. But it also feeds through to wealth destruction. It feeds through to real income impact because of the tariffs and inflationary effect. So through multiple channels, this can feed through. But right now, it is not for certain that we are heading into recession. Indeed, markets were pricing out one additional cut for this year to be around about 3 cuts. And the longer it lasts, obviously, risks of that increases.
Right. And as you said, Wei, the fundamentals have still held up. So how important is it going to be to get a read from corporate America in the earnings that we have coming up?
Earnings have been revised lower from mid-teens at the beginning of the year for U.S. equity market to now high single digits. Frankly, there is still room for earnings to be revised even lower because bottom-up analyst revision tends to be a bit slower than top-down revision. Now, having said that, the big picture as I look ahead to earnings season that is starting in earnest, it's not so much about kind of the backward look earnings, which are likely going to paint a picture of still kind of robust resilience. I'm paying attention to forward guidance. Are they willing to give forward guidance? I think some of them will pull forward guidance, but some will give forward guidance. That's important to pay attention to, but also what companies are doing to their kind of international supply chains. Are they changing them? Are they moving them? How are they kind of speaking to kind of cost pressure? These are the things that I'm paying attention to because right now margin is still quite elevated, and we will see if they manage to stay at these levels.
Yeah, we'll see if there are others like Walmart who said that they're basically going to absorb the cost pressure. Wei, it's always such a pleasure to speak with you. Thank you for starting your week with us, Wei Li of Blackrock. Now let's get some other top stories that are trending on the terminal this morning. Italian billionaire Gianluigi Aponte is leading an investor group seeking to buy CK Hutchinson's ports. Sources tell Bloomberg the Ponte family's business will be the sole owner of all the ports, except for 2 in Panama, which will be controlled by Blackrock. The sale has drawn opposition from China and scrutiny from Panama. Elsewhere, Sony raised the price of its PlayStation 5 console by around 25% in Europe and in the UK, all of that ahead of a likely US price hike. The PS5 will cost €500 in Europe and £430 in the UK starting today. Sony cited inflation and a, quote, challenging economic environment. The Federal Aviation Administration ordered tour operator New York Helicopter Charter to cease operations while it reviews its license and safety record following a deadly crash last week. The April 10th Hudson River crash killed the pilot and its 5 passengers, a Siemens executive, his wife, and their 3 children. Coming up on the show, President Trump warns tariffs are coming for electronics, while President Xi tours Southeast Asia. We'll have the latest for you coming up on your Bloomberg Brief. Stay with us.
The tariffs will be in place in the not distant future because, as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future.
What rate the semiconductor tariff?
I'm going to be announcing it over the next week.
President Trump speaking from Air Force One on Sunday, pledging U.S. tariffs will be imposed on phones, computers, and consumer electronics, despite a temporary exemption announced on Friday. For more, we're joined by Bloomberg's executive editor for global tech, Peter Elstrom. Peter, there feels to have been a lot of back and forth. Just catch us up on where we exactly stand with tariffs on electronics.
It was a very dramatic weekend. So very late on Friday, we got notice in a government filing that certain products, including smartphones, the iPhone, Apple's iPhone in particular, other products like the iPad, computers like the Macs, would be exempt from these very high tariffs on goods going from China into the United States. Those are 125% tariffs. That was seen as a very serious threat for Apple in particular, some other companies too, but Apple in particular because they make most of their products within China. They're shipping many of them into the United States, too. So that was an exemption on Friday. As we saw over the weekend, though, the Trump administration walked back that exemption. They talked about how these goods are not going to be permanently exempt and that this was a temporary reprieve, in fact. So Howard Lutnick, the Commerce Secretary, first talked about this on the morning shows on Sunday. And then Trump, as you were mentioning, talked about how these tariffs are going to be implemented. They've talked about using something called Section 232 to do this. That's a process that's fairly long. It's pretty open. They get public commentary to try to figure out what those tariffs are going to be. Trump referred to the tariffs on steel in particular. Those are about 25%. So you could see a pretty dramatic come down from 125% to about 25% for some of these products coming from China into the United States, although we don't have those specifics quite yet.
And you can see the market reaction, Peter. It is one of relief, and many analysts saying that you've avoided the worst case scenario. But in the scenario that you're laying out, Peter, where you still have something above 20%, of course, they still have the 20% fentanyl tariffs applied to them. How troubling will that still be for Apple's supply chain, for the big tech players' supply chain?
Well, 25% is serious. Obviously, it's a big chunk of expense for Apple and for customers, probably. But it's much lower than the 125%, which looks like a bit of a crisis. And yeah, even though those tariffs are going to be delayed and eventually implemented, it also gives Apple a fair bit of time to make some decisions now to be able to mitigate those tariffs over the next few months. For example, they're trying to produce out of China. They can ship many of those goods into the United States right now. And they're really ramping up production in India, which is subject to much lower tariffs. We had another exclusive over the weekend. that showed that Apple's production in India jumped 60%. They're trying to build more of their iPhones there. They've begun producing their most advanced iPhones, including the titanium iPhone Pro that they make, that they sell. They want to be able to sell as many of those phones from India into the United States because they can then get a lower tariff rate. And they want to make sure that they have diversity of production for the iPhone in particular, but also for the rest of their products like iPads and Mac computers.
Peter, we really appreciate that update. That is Bloomberg's Peter Elstrom. Now, in the meantime, the Chinese Ministry of Commerce released this statement in response to the tariff exemption of those certain consumer electronics. Quote, "This is a small step by the U.S. towards correcting its wrongful action of unilateral reciprocal tariffs." It also urged the U.S. to take a big stride in completely abolishing the wrong action and return to the correct path of resolving differences through equal dialogue based on mutual respect. For more, let's bring in Bloomberg China economy and government editor Alan Wang. Alan, does the reprieve at all represent a thawing of tensions between China and the U.S.?
Well, we thought that it did because, well, the Chinese Commerce Ministry called it a small step in correcting what it called Trump's mistakes. But then after Trump kind of flip-flopped and talked about how those products, including computers and smartphones, will get tariffed later on, albeit probably at a lower rate than 125% that the markets feared, China may have changed its mind. Because if that was one small step in correcting a mistake, then what was this walk back? It's kind of a step going backward. Just before this, we know that China was hit by a massive tariff from Trump after it retaliated, unlike other countries, and China didn't get a 90-day pause. So what happens now is that China needs to figure out how to move forward and to see what Trump will do next, to see if a talk between high-level Chinese and U.S. officials are at all possible.
And President Xi is overseas in Southeast Asia and Vietnam. Alan, how much of that moving on is just about strengthening ties without the U.S.?
Normally, a trip like that would be about China talking to its neighbors to make sure that they're still very much friendly to China, even though they don't agree on everything. But at this time, coming just a couple of days after Trump put massive reciprocal tariffs on China and gave everybody else a 90-day reprieve, the trip has taken on extra meaning. Xi Jinping just landed in Vietnam a couple hours ago, and he's about to meet with his Vietnamese counterpart. China is Vietnam's biggest trade partner, and they will have a lot to talk about. First of all, one thing that will be on Xi Jinping's mind is that he wants to make sure that Vietnam, as well as Malaysia and Cambodia, those countries he's visiting this week, will not sell China out for a deal with Trump. We know that those three countries, they are actively seeking a deal, and some of them said they were sending representatives to Washington to negotiate. China want to make sure that they don't do anything that come at a cost of China. We know that the Trump administration said they want those countries to crack down on what they see as illegal transshipment of Chinese exports through those countries into the United States, trying to dodge the tariffs. But in what forum those three countries will comply with that request, we'll have to wait to see. Over the coming days, we'll see if China reached new deals with their neighbors. And the other very important thing to look out for is that how those countries think about its position between the U.S. and China. As we've seen before, they would be loath to take a position in this great power rivalry. And so they have to basically walk a tightrope between placating China and the U.S. at the same time.
Alan, a really fantastic setup for what we might see this week. Thank you for joining us. That is Bloomberg's Alan Wang. Coming up on the show, the first all-female crew to space. More on Blue Origin's star-studded flight. That's coming up next. Welcome back to your Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news now. Look at what's making headlines around the world. First up, the New York Times has this on their front page: the results of President Trump's annual physical exam. The president's physician said he, quote, exhibits excellent cognitive and physical health and is fully fit to execute the duties of the president. He also has high cholesterol, which, according to the report, is being treated and is well controlled. Next up, Forbes leads with this. An all-woman crew will be blasting off to space in a live stream launched this morning on a Blue Origin flight. It includes pop star Katy Perry, journalist Gayle King, and Jeff Bezos' fiancee Lauren Sanchez. Kind of wish it was all scientists on the first all-female space trip since 1963, but regardless, we will have live coverage of that space launch. And on the Wall Street Journal, something that I think you all were watching alongside the headlines. What was more volatile, the policy headlines or the Masters? Either way, Rory McIlroy has won the Masters, marking his 5th major title. It makes him the 6th to complete a career Grand Slam by winning all 4 majors. He's the first European to manage it, and the 2nd in the past 50 years. The other is Tiger Woods. Okay, quick check on your equity markets. A rebound on hand with apparent reprieve for electronics. They're still, of course, subject to the 20% fentanyl tariff, and President Trump says that tariffs will be coming for the sector. But still, we're able to rally 1.4% for the NASDAQ 100. Your S&P 500 future session is up 1.2%. By the way, this is off the best week last week since November 2023. Maybe didn't feel that way because of all the volatility. A quick check on currencies this morning because the Bloomberg dollar spot is at the lows for the year. That dynamic continuing of volatile risk assets and a lower dollar. At what point do you get worried? Your euro stronger by about 0.4%, trading just below 114. Coming up on the show, we're going to be catching up with JPMorgan's Kelsey Berro on whether there's still a path to avoiding recession and what credit markets look like from here. You're watching Bloomberg Brief. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Tech tariff warning. President Trump pledges that he will still apply tariffs to certain electronics, downplaying a weekend exemption. Dollar decline. The greenback drops to a 6-month low on concern that tariff policy will drive traders away from U.S. assets. And we discuss the looming global trade war and market turmoil with Mathias Döpfner, Axel Springer, CEO. Are you thankful? It's a holiday shortened week. We just have 4 days to get through, and here's the setup for it. It is a rally on hand with outperformance from tech, 1.4%, with on Friday U.S. Customs saying that they would be exempt from the bulk of China tariffs, still getting that 20% tariff, though, due to fentanyl. President Trump, though, yesterday saying that tariffs will come. Howard Lutnick saying something similar. Despite that, we are still rallying. Citi, though, and Morgan Stanley downgrading their outlook for U.S. stocks just this morning. When it comes to your bond market, we're coming off the back of the biggest 30-year yield increase since 1987. We rally this morning. Yields lower by 4 basis points on the front end, just about 4 for your 10-year yield. We are at 4.45. The dollar, though, that trades at new lows for the year with your euro just below 114. Let's look underneath the surface here with some stocks to watch. Is Bloomberg's Joe Easton. Good morning, Joe.
So we are seeing some big gains in the tech sector today, Danny. Given those headlines you mentioned around the tariff exemptions for the tech space, particularly smartphones, PCs, laptops, that kind of thing. So therefore, Apple, one of the best gainers today. We're up around 5% for the iPhone maker this morning, and also seeing some chip makers gaining as well. Take a look at Texas Instruments rising following a slump on Friday as analysts at Evercore say this is the time to buy the chip heavyweight company today. And then in the metal space, a report in the FT saying Trump going to sign an order allowing the stockpiling of some metals, and that is boosting stocks, including TMC. Take a look at that, 20% gain for that stock. And then, of course, it's all eye on Goldman Sachs earnings coming up very shortly. Those equity traders have been very busy over the past quarter, and we're expecting to see that reflected in their quarterly numbers in a few moments, or in a few hours, I should say, and the stock is up around 2% at the moment for Goldman, Danny.
Joe, in this day and world, a few hours goes by in the span of minutes. So I think that is fair to say. Bloomberg's Joe Easton will get those results at about 7:30 a.m. New York time. Now, you have seen some cracks, perhaps, in credit markets. The U.S. leveraged loan market was closed for a second straight week without a deal, and saw the biggest weekly outflow ever last week. In high yield, it saw the largest one since 2005, and there really haven't been any new deals for that market since April 2nd. Pleased to say that joining us now is Kelsey Berro, Executive Director of Fixed Income at JPMorgan Asset Management. Kelsey, thank you so much for joining. I'm sure
to be here.
It's hard to get away from your desk these days. Look, The credit markets had been holding up remarkably well, but we have started to see some pressure. At what point does the pressure become concerning?
So the way that I would look at this is there's cost of credit and there's availability of credit. Right now, credit is available. It's just that companies don't really like the cost. The costs have been rising because spreads have been widening. So you're seeing companies stand down in terms of issuance. But if they did need to issue, we do believe that the market would be there to receive the issuance. And when you look at the past week and what's different about this time versus COVID is that the short-term funding markets are still functioning, and we do think generally credit markets are still functioning. What's happening is a rational repricing wider in spreads to reflect the higher uncertainty and greater risk of recession in this environment.
I'm glad you pointed that out because we did have a lot of talk last week and the week before. Is the Fed going to have to step in because of some sort of dysfunction in the market like we had at COVID? When does it look like that? Just how far away are we from a Fed that needs to step in, driven by the credit market?
So I think we are far away from that. There is essentially two environments where I think the Fed is going to step in. One is a function of credit dysfunction, and particularly in the short-term market, so the repo treasury funding market. We're not seeing that. The other would be actually driven by the hard data, and that's the one that I'm more watching. So we still believe that the Fed is ultimately going to be more sensitive to downside growth risks than to upside inflation risks, but they really need to see it in the data itself in order to justify easing policy at this point.
Then what do you make of the recent Fed speak we've had? Because we heard from Kashkari over the weekend speaking to CBS's Face the Nation, saying at the Fed, our job is to keep inflation under control so that rates aren't higher. It seems like that seems to be the conversation, that we need to keep inflation expectations well anchored. But you're saying that they are more sensitive at this point to downside growth than the inflation expectations.
Right. It's just that you haven't seen enough evidence that the labor market is cracking, and that's why they have no reason to respond. I actually think that while survey-based measures of inflation have been concerning, the University of Michigan again on Friday really looking terrible in a lot of different facets, not just higher inflation expectations, but also lower growth expectations and expectations of much higher unemployment in the coming year. But essentially, what I think is more important is I think that the Fed is also looking more at the market-based measures of inflation expectations, which have actually been falling. Outside of the one-year part of the inflation curve, if you look at the CPI swap market, the rest of the market is actually pricing in lower inflation expectations. So it's understanding that this is a one-time hit to inflation, and then the secondary round impacts are actually lower growth and lower demand. And therefore, inflation expectations in the long end, I don't see as becoming unanchored. The move higher in long end yields has been a function of higher real yields. So you have the 30-year real yield at the highest level since the GFC.
I was going to say, given everything you just said, if you didn't look at markets, you'd probably expect yields would have gone down, but we didn't get that. And you also had a weaker dollar. And you kind of get this narrative coming for the first time that something has changed, that perhaps we do look like we're something at peak U.S. asset. Does it look like that at all?
So structurally, I do think that there is going to be continued pressure on the dollar, and we may be past that peak in U.S. exceptionalism. But the price action last week really screamed to me more technically oriented than anything else. So we saw unwinds in a number of very crowded, popular macro trades, things like swap spreads, treasury basis, inflation, cross-market trades like U.S. versus Germany. I just think that there was a substantial washout of quite a number of trades that were on a leverage basis that was creating a lot of friction. And one of the telltale signs for me that this was more technically oriented is you had 3 days in a row last week where the 2-year and the 30-year yield went in opposite directions. That is historically rare. And so I'm hopeful that this week, it may be another volatile week for yields, but it should be a week if it's volatile for yields, it's going to be driven by the economic data, not because of a washout in terms of positioning.
So just to put a bow on it, do treasuries still have a place in portfolios as a ballast, as a haven?
We do believe so. Our range for the 10-year for this year, and it really hasn't changed much despite all this volatility, is 375 to 450 on 10s. We're right at that upper end of the range. I think you want to be smart about adding duration in your portfolio, but we do think long-term there's still quite attractive value and diversification benefits for having high-quality fixed income in your portfolio.
Kelsey, in this moment of volatility, it's so nice to hear that you are sticking with your targets and with your outlook and your process. Thank you so much for joining this morning. Always a pleasure to catch up with you. That is Kelsey Berro of JPMorgan Asset Management. Coming up on the show, a conversation you don't want to miss. German billionaire and Axel Springer, CEO, says if President Trump is serious about America first, it shouldn't mean America alone. He joins the show next. This is Bloomberg.
Tariffs will be in place in the not distant future because, as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future.
What rate of the semiconductor tariff?
I'm going to be announcing it over the next week.
President Trump speaking from Air Force One on Sunday, pledging that U.S. tariffs will be imposed on phones, computers, and popular consumer electronics, despite a temporary exemption announced on Friday. For the latest, we go to Washington, D.C., where Bloomberg's Tyler Kendall joins us. Tyler, where exactly do we stand on tariffs for electronics?
Yeah, hey, Danny. Well, it's unclear how long this reprieve will last because it does appear evident that these tech imports are going to be subject to a Section 232 investigation, which could take weeks or even months. We have to keep in mind that when President Trump signed his original executive order on April 2nd, it always excluded chips and also those other key industries that you heard him mention there, like pharmaceuticals, lumber, and copper, that could be subject to tariffs on the basis of national security concerns. It now appears that these tech imports will fall under that umbrella for the sector-specific tariffs instead of the umbrella of the so-called reciprocal tariffs, as we heard President Trump before saying that they're just moving these from one bucket to another. We have to keep in mind, though, that when this White House has invoked Section 232 before, including on steel and aluminum, as well as auto imports, they've put into place a 25% tariff. That is, of course, much lower than they could have been tariffed if they were subject to the now, for example, 145% tariff against all Chinese goods, but it's still considered to be pretty punitive because we have to keep in mind that how these sector-specific tariffs are designed, they're typically designed to be stacked on top of any other existing levies. Now, Danny, we have to keep in mind that this latest reprieve applies to about $390 billion worth of imports. About a quarter of that is coming from China. So as these companies try to lobby this White House for any future carve-outs or exemptions, they're really going to be looking at their supply chains and how those could be impacted as these goods get shipped to the U.S. It is something that President Trump said that he was open to yesterday, talking with these companies, saying that he believes there will be some sort of flexibility.
Tyler, you're struck just listening to that by the sheer volume of negotiations that this White House is going to have to undergo. Not just the companies, but we are still on the clock for the 90-day reprieve for reciprocal tariffs. Do we have any insight as to how those country negotiations are going?
Right. So this White House is assuring that there will be some sort of certainty over the next 90 days. But of course, as you well know, it's hard enough to strike a trade deal, let alone in such a short timeline. This administration keeps pointing us to the fact that 75 countries have reached out so far to negotiate. Now, of that, NEC Director Kevin Hassett sort of narrowed the scope last week, saying that there's about 20 countries that they're approaching when it comes to having what he characterized as a sensible deal that they are putting on the table. We know that this White House House is also prioritizing those countries that are geographically close to China, like Vietnam, India, South Korea, Japan. Also countries that China's Xi Jinping this week are targeting as well. In Vietnam this morning, saying that he wants to strengthen trade ties with the country there as this White House really tries to find a way forward. Now, Danny, we could get a little closer of a view about what a potential trade deal could look like, particularly with the European Union later this week. Italian Prime Minister Giorgia Meloni will be here on Thursday and is going to be talking about the full scope of the EU since the countries got tariffed as a bloc.
Tyler, excellent reporting as always. Bloomberg's Tyler Kendall. And don't miss our exclusive interview with U.S. Treasury Secretary Scott Bessent. He'll be speaking to Bloomberg Surveillance co-host Anne-Marie Hordern from Argentina, 4 p.m. New York time. Now, President Trump's tariff pause has given the U.S. and its trading partners time to negotiate a deal, as Tyler was just saying. In an opinion piece in his outlet, Politico, Axel Springer CEO Mathias Döpfner argues for a swift U.S.-EU trade agreement before renegotiating terms with China. He says if Trump is serious about America first, there's one thing he should come to terms with. It shouldn't mean America alone. I'm pleased to say that Mathias joins us now. So excellent to see you. And I'm saying even before this Politico column, you published a book late last year, which was so prescient, arguing for this idea that the West shouldn't have given China full trade openness and that there should be change through no trade and heavy tariffs. Mathias, I have to imagine someone from the White House was reading that because they've embarked on that journey. Has the past 2 weeks helped achieve the goal that you lay out or complicated it?
Hi, Danny. Thanks for having me. But truly, I think that the developments may help to achieve a surprisingly positive outcome. I think the 90 days pause is absolutely helpful because we have seen the limits of trade war with everybody. On the other hand, it's pretty obvious that we got to do something with regard to China, and that is very much in the interest of the United States, but also in the interest of Europe. We have to stop that asymmetric trade allowed by the WTO, implementing double standards. China, treated as a developing country, has been able to grow its contribution to world GDP from 3.8 to 18.5% in 20 years. That cannot continue. But if you really want to achieve something that is beneficial for the United States, then you should not do it alone. And that's why I'm proposing a very simple solution.
You shouldn't go at it alone, Mathias, but will you have to go at it alone? Will the U.S. have to go at it alone because of the unpredictability of the nature of the policies we've gotten from President Trump? Of course, that is a feature often in negotiating. But is there a fear that that pushes allies away from the U.S. to achieve the aims that you're laying out?
That could happen, but it may not happen, and I think it will not happen. I would suggest very concretely that we move now in 3 steps. Step 1, that Europe, perhaps ideally under the leadership of the new German Chancellor Friedrich Merz, reaches out to the present administration, negotiating a no-tariff trade deal between Europe and America. If it's not no trade, then it has to be symmetrically low tariffs. And either no tariffs or low tariffs will strengthen these 2 economies. And in return, of course, Europe has to agree on a mutual trade strategy towards China. And then in step 2, the US and Europe are announcing high prohibitive tariffs towards China. In step 3, then, you sit at the negotiation table representing 800 million citizens, representing the biggest and the 3rd biggest economy in the world. And the leverage that you have in these negotiations in order to achieve something that is really symmetrical, that is beneficial then to the US economy, to the EU economy, but also to a certain degree more attractive for China than a trade war, that is very high. This likelihood is high, and it got higher after the recent events. So although it looks a little bit puzzling and disturbing what we are seeing at the moment, I'm more optimistic than ever that we can really achieve a transatlantic trade alliance as a basis for better policy towards China.
Mathias, I hate to pour cold water over any optimism. I think we need it in this day and age. But you have seen the Spanish Prime Minister head to China and talk about a deepening of ties with China and the EU. There's a summit also planned for July, and EU and China have started to discuss maybe restarting talks over the dispute when it comes to EVs. Does that movement of Europe towards China trouble you then?
Absolutely. And I think that is even another reason why we need a transatlantic solution. We need a transatlantic trade agreement. Otherwise, not only the US will tap into a trade trap, but also it'll force Europe to move closer to China. Europe is already relatively dependent on many levels from China. And if we now basically, through an isolationist approach, push Europe closer to China, I think that's going to be bad for the US economy. It's going to be bad for the European economy because Europe becomes more and more dependent, and the only winner will be China. So we shouldn't let that happen.
Well, Mathias, you don't only just think about these matters, you have to actively put money towards these matters because you make big transatlantic investments like your ownership of Politico, for example. In this moment, does the U.S. look like an attractive investment for you? Would you put more money to work in the region, or would you wait for some of these tensions to play out?
The short answer is absolutely yes. We see that reflected in our figures. We had a very good first quarter, so we are ahead of budget and previous year. And also on a kind of longer term, in a longer term context, I'm a strong believer in the US and on the pragmatism of the United States of America and its people. So I don't see any reason to lose that optimism, honestly.
Well, you might have a little bit more money alongside to do just that. Of course, in September of last year, you had that deal with KKR to split up the business. Do you have any plans for capital injection from that new source of funding coming from KKR?
Well, after the split, that's going to be closed in the next weeks, in any case, until the end of the second quarter. We have a digital media company, a transatlantic digital media company with assets in Europe and in the US that is debt-free. And with that, of course, we have a different time horizon for investments and for entrepreneurial energy. It's not the next quarter's results that are the most important priority. It's the value creation in 3, 4, 5 year time horizons. And that's, of course, a very, very good position to be in. We are absolutely excited about it. We are looking forward to that. And as we have just discussed, of course, Europe remains an important market, but we are already the #1 there. America is full of opportunities, is the biggest media market in the world. So things will also develop in America, hopefully, and we have lots of ideas.
Mathias, unfortunately, we're going to have to end it there. I think we could talk literally all day, so you'll have to come back and join us. Thank you so much for your time this morning. Mathias Döpfner, Axel Springer, CEO. This is Bloomberg. Let's get you set up for this trading week, a holiday shortened one. Goldman Sachs will be reporting earnings today at about 7:30 U.S. New York time. Bank of America and Citi, those come out tomorrow. Plus, Fed Chair Powell will be speaking at the Economic Club of Chicago on Wednesday. We'll also get retail sales data on Wednesday. We'll also get an ECB rate decision. That comes on Thursday. Let's look at some movers this morning. Apple higher in the pre-market session by more than 5% with the Trump administration exempting electronics from so-called reciprocal tariffs. And news that came out earlier this hour, Intel nearing a deal to sell a stake in its programmable chips unit to PE firm Silver Lake. Intel up 3.8%. Goldman Sachs also rising ahead of their results, up nearly 2% with trading on equities really strong from the banks that we've heard from so far. Let's get a quick check on currencies this morning because, yes, risk might be coming back, but the dollar is still weaker this morning. The Bloomberg dollar spot trading at its weakest level so far of the year. Again, the weakness isn't huge, but at what point does that dynamic start to become troubling? Okay, that is it for Bloomberg Brief. Surveillance takes the reins from here on this Monday morning.